So this is a list I have here, top 5 things that I think individual investors should be concerned about, not to the point where it causes you to make any investment decisions or go against some of your investment decisions, but something that I think everybody should keep this in the back of their minds, a list to keep in your back of your mind. And these are 5 things that I've come up with that I think that it's possible if any of these things happen, it could derail stock market and its performance, meeting new highs on a regular basis, as we seem to have in the last, well, for the first 6 months of this year. If any of these things were to happen, I think it could be a negative for the stock market. And here are the 5. An overheating U.S. stock market, which we're starting to see. Federal Reserve too slow to cut rates, which we've touched on already. U.S. elections. We're going to have a U.S. election in November of this year. And I think there are risks to both candidates. Geopolitical issues. We had a guest on our show, Matt Gherkin, last show, talking about the relationship between China and the United States and that tit for tat, the rhetoric going back and forth between the two countries, and how we both, him and I, think that this is a major issue and can be a major issue for all of us and the stock market. And not to mention a lot of the geopolitical events taking place around the world, the wars in Ukraine and Middle East. So a lot of geopolitical issues that could pop up in the coming months. And last but not least, I put it last on the list for a reason, because I'm not sure it's going to happen. But if oil prices were to surge once again to go well above $100 a barrel, how would that affect the stock market? So these are the 5 issues that I think are important to focus on. So let's take each one of them briefly and go into it. The first one, overheating U.S. stock market. Our first chart here is on the S&P 500 PE ratio. And you can see it here. You can see the chart. We can pull it up. S&P 500. You can see a spike. There's our spike in 2000 and right before the financial crisis, actually. The end of 2000, 2007, 8 time period, we saw the financial crisis. The PE ratios on many of the stocks came crashing down, and we started to pick back up. And we saw a bit of a downturn, obviously, during COVID, 2020 timeframe, and then spike higher in and around 2022, 23, and came down and back up again. And so what does this tell us? Well, this tells me that the S&P 500 right now, you're trading in and around, well above the 20 times earnings mark. And usually S&P 500 trades somewhere around 18 times, especially when interest rates are lower. When interest rates are higher, like we see now, many people believe the S&P is stretched, overstretched, trading at too high of a multiple. So you want to be mindful of that. If this stretching of this S&P 500 or the stock market in general continues, it's something to be possibly concerned about. Now, I will say, obviously, as we know, a lot of this is because of the tech names. There are many names that aren't stretched, that still represent good value. And that's where you want to be, in my opinion, in this market. You want to own a few of the tech names, but you want to look for those names that still have not gone a lot higher. So overstretching of the stock market on a price multiple earnings basis is something to keep in the back of your head. The second one, we've touched on this, Federal Reserve too slow to cut rates. And one of my favorite charts of this show is the next chart that we have. And this is U.S. policy rate and recessions. And it's interesting because it compares what the Federal Reserve is doing in terms of interest rates. There it is. And right after, those shaded areas are recessions. And you can see very clearly that every time interest rates move significantly higher, it's followed by some sort of downturn in the market or recession. And here we have on the far right-hand side, another spike in interest rates, but we have not seen that recession or downturn in the market as yet. Will it come at some point? This is the fear that many people have. And that's why I have the fear that if the Fed doesn't cut rates soon enough, that it's going to be too late and we might get into a downward period for the stock market. So that's why many economists are saying the Fed needs to look at the rate or the rate of change versus the actual number itself. If we see numbers going up slowly or slower than before, or even in a decline, that is far more important and a bigger signal than the actual number itself. The number still may be at 3%, but if the rate of change is definitely getting smaller and smaller, that should be good enough for the Fed to cut rates. The third point, I mentioned U.S. elections. Obviously, the current president, President Biden, will be going up against the former president, President Trump. And we've talked about this briefly in other shows. It'll be a very important event, obviously, to say the least, for the economy, the stock market. And the one thing I wanted to show in our next illustration here, we've had this illustration up before, and just to talk about, so the S&P 500 index returns in U.S. presidential election years. And you can see here that overall returns in all election years, the return of the stock market is over 11% average. That's phenomenal. And maybe that has something to do with why the market's doing so well this year. When a Democrat is elected, 7.6%. When a Republican is elected, 15.3%. And you can see here the third point or observation, when a Democrat was in office and a Republican was elected, the total rate of return averaged almost 13%. So when you get a Democratic president, as we have now, replaced by potentially former President Trump, that would, on average, look to be the best case scenario for the stock market. Now, obviously, there are risks on both sides. Former President Trump wants to increase tariffs. The current President Biden wants to increase taxes. There are pros and cons to both, I'm sure. But overall, history has told us if you have a current Democratic president replaced by a Republican one, that tends to be the best scenario for the stock market. And I guess last but not least, when you look at, I should say, second last point, I should say, we have one more after this, the geopolitical scenario, geopolitical issues around the world, as I mentioned. This is, again, that tit for tat between China and the U.S. We know the U.S. just recently put tariffs, slapped larger tariffs on a lot of the imports out of China, up to $300 billion worth of goods coming into the U.S. will now have higher tariffs. We have an illustration here that will clearly show the amount of tariffs that are being added to the current tariffs that President Trump put on a lot of the Chinese goods. You can see here, electric vehicles, 25% tariffs originally, now up to 100% tariffs. Semiconductors going to 50%. Solar cells, syringes and needles, all up to 50%. Lithium, EV batteries, 25% from just 7.5%. This is what the United States is doing with Chinese imports. And it is, you can see here, $300 billion worth of Chinese imports. What will the Chinese do? They've already retaliated with a number of measures on their side. And the worry is that this could continue. If the U.S. were to continue with certain tariffs or other measures against China, not sending over their best chips to China, China will retaliate in due course back and do certain things to what they send to the U.S., or perhaps limit what some of the businesses can do, like Apple, like Starbucks, like some of the chip makers and tech companies in China. What could they do to these businesses to I guess, extract a bit of a tit for tat? They didn't do this from the United States. They put tariffs on our exports. We're going to do certain things to what they sell us, or what China gives to the United States. So geopolitical events, in my opinion, is something. And again, as I said, we haven't even spoken about what's going on in the Middle East and Ukraine. Obviously, those are massive events that have gone on now for quite some time. And if there's any change in the Middle East and what's going on, or change in Ukraine, then that could obviously cause an issue for the stock market as well. So something to keep your mind on, to keep in the back of your mind with respect to geopolitics. Last but not least, as I had on our list, is the price of oil. I think if oil were to spike based on geopolitical events, or based on cutbacks by OPEC, or a spike in demand for oil around the world, if oil were to hit maybe $100 a barrel and go beyond once again, what would it do to inflation? I think inflation numbers would start to pick up all around the world once again. Things would be a lot more costly. And so oil prices, I have it fifth on the list. I don't think we're going to see a big spike, but anything is possible. There could always be an event to cause a spike in oil prices. If that were to happen, I think that could perhaps slow down this current market rally. So 5 things to keep in mind and put in the back of your mind as we move forward with our investment decisions, creating our portfolios. These are things that I believe will unfortunately remain in the background for quite some time, and hopefully they don't come to the forefront.